Good afternoon, everyone, and thank you for joining us. We're going to let everyone continue to log on, and we'll get started in just a couple of minutes. All right, we'll go ahead and get started. Hi, everyone. Thank you for joining today's webinar, Key Considerations for Your Healthcare ERISA Plan. Today's program will be presented by Izzy Tannenbaum, partner, Kevin McElgunn, senior manager, and Anna Romeo, manager in Withum's ERISA services team. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen and will be distributed to you after the program. Also, at the bottom of the toolbar, you will see a questions box. Feel free to send us your questions during the presentation. We will do our best to address them at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, when the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. I will now turn it over to Anna.
Thanks, Rachel. So good afternoon, everyone. My name is Anna Romeo, and I am part of the Withum ERISA practice, and I focus mainly with our healthcare entities. And I've been in the practice for a little over 8 years now. So looking forward to going through some stuff with you today. So I'll hand it over to Kevin.
Hey everyone, good afternoon. For anyone on the West Coast, good morning. I'm Kevin McElgunn. I'm a senior manager here at Withum. I've been working on healthcare ERISA audits for about 10 years. I also do 11K audits, which are the public filings of ERISA audits. So excited to talk plan mergers and common deficiencies and kind of let you know what we're kind of seeing in the healthcare industry. Turn it over to Izzy.
Hey, good afternoon, everyone. My name is Izzy Tannenbaum. I'm a partner in our National Tax Service Group. I specialize in exempt organizations as well as employee benefit plans, really on the tax side, and have about 20 years experience practicing in that area. I'm very excited to be here with you today to share some information about the latest developments.
Okay, so with that, we'll jump into our learning objectives. So at the end of today's presentation, we hope that you're going to walk away with a better knowledge of some common deficiencies that we see, especially within our healthcare ERISA clients. We're going to talk about some practical resolutions and just some ways that you can maybe address or try to mitigate those deficiencies. We're also going to talk about some common pitfalls when dealing with plan mergers. Plan mergers is something that we see quite often in the healthcare industry. Considering all the mergers and acquisitions. And then also, then Izzy's going to talk about the voluntary corrections programs, talk about some nuances with 403Bs, and then also go over some Form 5500 requirements. So moving on to the next slide, we are going to jump into common deficiencies. So we broke these up into 4 separate categories. The first we'll talk about is documentation, so maintaining documentation for your plan, and oversight over the plan and evidencing that with certain types of documentation. Then we'll transition to employee contributions regarding late deposits. So that's the timely and proper remittance between when the participant has their deferral withholdings from payroll and when those deferrals are then deposited into the participant's account at the service provider. Then we'll talk about definition of plan compensation. This is a very critical area that we notice a lot of issues with, primarily because there's just a lot going on with knowing the different payroll codes, and this also is an area of focus for the DOL. So you know, we always like to talk about eligible compensation and make sure that that's properly defined. And then we're going to talk about forfeitures, which I acknowledge not everyone might have to deal with forfeitures. This is if your plan has an employer match or say a non-elective contribution or profit sharing. So that's where forfeitures will come into play. And I just wanted to caveat that ultimately, as we're talking about this, we do recommend that plan management does discuss any plan deficiencies with ERISA counsel to determine proper corrective action. ERISA counsel will know best regarding the latest regulations, and they can give you the best resolution direction. And moving on to the next slide, we are going into polling question number 1.
Okay. So here is our first polling question. We'd like to get to know our audience, so please select your department. All right, about 20 more seconds.
Oops, I realized we had a spelling mistake too. I guess no one's a part of human recourses, right? Or human resources.
Sorry about that. That was my bad.
No, that's, I think I sent it like that. I'm an accountant, not an English major, right?
All right, I'm going to go ahead and close it out. And here are the results.
Okay, so we do have a lot of finance and accounting individuals on the line. Okay, I'm curious what the other pool is. So yeah, we'll try to take a look at this from the finance and accounting perspective mainly, but you know, we're going to cover things from multiple angles. Okay, so the first thing we're going to talk about is documentation and oversight. So one of the things that comes up fairly often is that plan management is not documenting the regular meetings or any other important discussions or decisions held during these meetings. So you know, we always recommend that there's some sort of memo put together, or you know, make sure you have documentation that you are performing oversight over the plan and talking about the investments, talking about plan participation. These are important things that show fiduciary responsibility and show that you're you know, performing those responsibilities and showing proper oversight over the plan. So this is from a due diligence perspective. So I know some of my clients, they do have meetings, but then they don't document those meetings. So just try to get something in writing so that way you can evidence if someone comes to you and asks about it, you have the documentation to show them that you are indeed you know, having these meetings and you do have oversight over the plan. One of the next deficiencies we see is the authorization of a discretionary employer match or a non-elective employer match. So sometimes this is approved in some of the committee minutes. So the committee will talk about it, but essentially there should be some form of documentation of approval from the decision maker who's authorized to make that decision, whether there would be a discretionary employer match or a non-elective and how much that will be for. And just regarding maintenance of records, so I know especially in the healthcare industry, there are a lot of people that have been there for a long time. And through the various mergers, sometimes there are documents spread out across a couple different offices or locations. So it is important to try to make sure that you know where that documentation is. And especially with the missing personnel files. So really having those in a central location, a secure location is helpful. And throughout the year, sometimes we suggest that maybe management conduct audits of the employee files just to make sure that you can produce those records if someone were to come in and ask you for those files. Also, in regards to supporting waiver of participation, so these are opt-out forms. So a lot of third-party administrators, so your service providers like the Fidelities of the world, when it comes to opt-outs, this is more primarily for auto enrollment. They might have the election specifically on their website, but we have noted that sometimes a paper form is required to be filled out and signed by the participant and then submitted to the human resources or payroll department to show that instead of being automatically enrolled in the plan, they're choosing to opt out. So they do not want automatic withholdings. So make sure that you have those on file, because if you can't produce the documentation that the participant has opted out, then as an auditor, I would come in and assume that that person did not opt out and that they should have been auto-enrolled in the plan. There are some steps that can be taken, say confirming directly with the participant of their election, but those are additional procedures and additional time. So just make sure you have that documentation is helpful to keep things moving if you are under audit. All right, next slide. So here we'll talk about the late deposits of employee contributions. So the DOL regulation requires that the participants' contributions need to be remitted at the earliest date that they are reasonably segregated from the company's general assets. So as soon as you're able to identify when the payroll check is cut that this much is for tax, this much is for the employee deferrals or any other deductions, once that's reasonably segregated, you should be able to remit that to your service provider. In no case, however, should it be later than the 15th business day following the end of the month, which those contributions are withheld. So you might have heard of a couple, safe harbors, but really the DOL hones in on this a lot, because once, if say you deposit typically in 2 days, if you then take 3 or 4 days, you've already established a trend of being able to segregate those assets and remit it within 2 days. So then the question becomes, well, why did it take 3 days? Why did it take 4 days? So there just is some exposure there if you show a trend of a lower amount of days, and then there's a period of time where maybe you're taking 1 or 2 days later. And so the risk here is that when there's a failure to remit those participant contributions timely, that will trigger a prohibited transaction, which then gets reported on your Form 5500. And that also opens up the Form 5500. It's kind of a red flag to audit the plan. So, of course, you don't want that. And then you would need to calculate the lost earnings on those employee deferrals. Typically, that interest calculation is very minor. It could be just a couple dollars. I've seen it larger. Typically, it's not a very large amount, but at the core, this is a compliance issue. So even though the dollar amounts aren't big, of course, ERISA is very compliance-based. So you want to make sure that you're depositing those contributions timely. So if your organization does not have a written remittance policy, we do recommend that one is created so that, when you take a step back and you realistically look at how long it takes to remit the contributions, whether that be 2 days, 3 days, you want to have a policy in place so that way you have that documentation that shows this is your policy to remit within, say, 3 days. So as long as you're within those 3 days, you're in compliance with your trend for remitting those contributions. And one thing that we do recommend also is having an alternative authorized individual that is able to send the monies from payroll to your service provider. So the DOL has a very no excuses mentality. To them, they're protecting the participants' accounts, as they should. So even if someone is unavailable to remit monies within a timely manner, there should be an alternative person, like a secondary or even a third person that has the authorization to do so if that first person is not able to complete that task. So that's what we recommend, is that there's at least a secondary individual. So if there's PTO, family emergencies, someone's out of the office, that you have that secondary individual. Then moving forward to the next slide. We are now going to jump into definition of compensation. So for me personally, I could talk about this for a very long time, but we only have an hour. So with definition of compensation, this is definitely one of the top areas of non-compliance. So what we recommend for plan management is to take the following steps to really make sure you're understanding your definition of compensation and knowing what should or should not be included. So the first step would be to look at your plan's adoption agreement. If you have a standard plan with your third-party administrator, you would look at your adoption agreement. This is where you show your elections. I do have some healthcare plans that have a custom plan document. So if that's the case, you would just go to this section where it's defining compensation. And you want to make sure that you're able to see what the base definition of compensation is, and then whether there are any exclusions to that compensation. This is usually where I see a pitfall, where say your base definition is W-2 wages, and then you have exclusions of bonus or fringe benefits. Those exclusions is where it can get dicey, and where you know, there's a lot more analysis that has to be done on, you know, what exactly do bonuses comprise of when you look at the payroll? What do cash or fringe benefits comprise of? So that brings us into the next step of, you know, what are you using to calculate eligible compensation? So this is from a aspect of, are you using the payroll system to calculate eligible compensation? This is, I see most commonly payroll is used. Sometimes there are manual calculations. If you have a non-elective or a discretionary match, sometimes there is a separate file that is, you know, perhaps exported from payroll, but sometimes it's an Excel file. So manual files, you know, you do have that risk of human error, and you want to make sure that you know the controls in place over, you know, what information is in there, that the information is complete. And with the payroll side, you know, you want to make sure that you know who's adding payroll codes, and you know what those payroll codes mean and how they're classified. So going into the next slide, this is where we'll have an example of with the payroll codes. So what we recommend is that plan management puts together a master listing of the payroll codes, and then the corresponding type of compensation related to those payroll codes, and then whether or not that is considered pensionable or non-pensionable. So in this example, we have bonus and car allowance. So if bonus is just a strict bonus, you would indicate that that's bonus pay, and car allowance, you might indicate that's a fringe benefit. So in this example, we'll say that bonuses are not includable according to the plan document. So you would indicate that accumulator code AC01 is not eligible, and then accumulator BB car allowance, if fringe benefits are includable, then you would put that it is eligible. You know, this is very helpful. It does take time if you don't have this already. However, once you do a full run through of your payroll report and you have that full master listing, then on a go forward basis, you're just analyzing the new payroll codes and what has been added. And of course, if there's any plan amendments that may change the definition of compensation, you would need to include that. But then on a go forward basis, really just updating it year to year. So this is something that we recommend because it does give you a full picture of exactly what's included in payroll as far as your codes, and then whether or not they should be eligible or not eligible. And then you can see if in the payroll system, they're set up as eligible or ineligible.
Yeah, and I think like the best part about this, just from like a practical standpoint, like I know everyone's really busy. Things can easily get lost in emails. Things change. Maybe someone makes a change to the plan document or your plan document, but it's not communicated back to payroll, or payroll adds new codes. It's not 100% aligned with the plan document. Helps kind of like vet out kind of those issues early, just so you're being more proactive, I'll call it, versus kind of reactive, kind of waiting like, oh man, we might have missed this on the back end of it. So I think that's where, when we've seen companies do this, it really helps them out kind of on a going forward basis.
Absolutely. And on the next slide, that is, we actually mentioned that as one of the common issues with the healthcare entities. No, you're fine. You jumped right ahead. We're going to be talking about that. So what Kevin was referring to is mainly the lack of communication between payroll individuals and plan management. That is something that we see very often in healthcare entities because there are many locations, many different divisions. So payroll individual may add a new payroll code and then it sets it up in the payroll system incorrectly in terms of whether it's eligible or ineligible. So maybe there's something that really is a form of special pay, but they indicate that it's a bonus or a fringe benefit. And then depending on what's included or excluded for your plan document, that could affect whether or not payroll is calculating it correctly. So having someone who is maybe just the overarching oversight person for whether or not payroll codes are added, and those payroll codes have to be vetted through that individual, that could be a helpful control in place to make sure that no matter which codes are added at any location or division, it's running through an individual that has master control over the full listing of the payroll codes and how they should be set up. And on the flip side, kind of going the other way, sometimes we have seen that there could be plan amendments to the eligible compensation, and maybe that's not communicated to all the payroll individuals. So just making sure you have clear communication between those that are maintaining the plan document and responsible for oversight of, they want to have clear communication with the payroll individuals that will be setting up the payroll codes. Another issue that we've seen very often is that there are numerous payroll codes, both for types of compensation and things that are specific to divisions or legacy programs or legacy divisions that have come in through mergers. So master listing, to complement what Kevin was saying before, so that master listing really is helpful, especially if you have different payroll codes. And I know I'm kind of going backwards and going bottom up here, but also what we've seen is that there could be different definitions of eligible compensation for specific divisions of employees. Again, a lot of this is just coming from the consolidation that we've seen happening over time in the healthcare industry. So if there are different definitions of compensation, that adds a whole nother layer of complexity and complication that can happen when you have one division with a very different definition of compensation than another, but they're all in the same payroll system. So of course, harmonization of the plan's definition of compensation is something that I know can take a lot of time, but of course, just trying to take a look at the different definitions you have out there and working towards a harmonization project where you start to align the definitions of compensation, or even just align the payroll codes if you have a lot of variances there. That could be very helpful. Okay, so in the next slide. So with forfeitures, what we want to note here is that with forfeitures, the IRC requires that those forfeitures are used or reallocated to the plan participants in accordance with the terms in the plan document and the plan year they are incurred. So a lot of the common things we will see is that the forfeiture balance is not utilized. So that balance grows and grows and grows every plan year. So according to your plan, you have to go back to your plan document, but what we often see is that forfeitures can be used to reduce the cash requirement on the employer's end if you're making a matching contribution. Or they can be used to pay plan fees, or they could be used to just be reallocated to your plan participants. So the biggest thing here to note is that we have seen plans where the forfeiture balance grows, so that is something that you should be aware of, and you should really be using those forfeitures. And what you may need to do if you have noticed your forfeiture balance is growing over time is, again, consult with ERISA counsel to determine if there's an official correction necessary to bring the plan into compliance with the regulations around forfeitures. And then we're going to jump into now polling question number 2.
Okay, here is our second polling question.
So this kind of goes back to kind of what Anna was talking about earlier today. I'd be curious to see how many people get this answer correct.
All right, about 30 more seconds.
Yep, and then after this poll, we're going to jump into talking about planned mergers, and I'm going to be handing it over to Kevin.
All right, I'm going to close it out. And here are the results real quick.
89%.
Okay, there you go.
And a great job getting that through.
I'd like to think I'm a good teacher. Good for
Yeah. I think we could round it up to an A- on there as a team, so it's pretty good.
I'm fine with that.
So the next topic we're going to be jumping into is planned mergers. So in the healthcare industry, we've seen a lot of consolidation, a lot of companies buying each other and becoming larger entities, or some smaller entities just moving kind of up the ladder a little bit too. So there's a couple of things that we've been kind of seeing over the last couple of years with all these mergers is like these new companies that are being bought up by healthcare companies, eventually the plan that was at that former company being merged into a new plan, or we're just seeing a couple entities where there's a bunch of different legacy 401k plans by each of these existing companies, and they are all being terminated and the new plan is being started and all those assets are transferring to a new plan. And there's different cost benefits and savings for each one of these, but we're going to focus more at the plan level on details. But the main things we want to kind of talk about is, when is the plan merger date? Is that the same thing as the transfer of assets? And then what kind of files do we need internally as plan management to make sure everything's up to par on it? So next slide. So kind of what we want to do for kind of what can go wrong in a plan merger is, in the first case was the plan document amended to incorporate this new plan coming in. Is this old plan going to be having different eligible compensation metrics, or is it going to be adopting the new plan's metrics on there? So really kind of getting to the details of the plan document and the authorization behind plans merging together can make a big difference in there. If there's two plans that are merging into one new plan, you could set the parameters and everything a little bit differently, set new standards of what would make your company kind of run a little bit more cost effectively from a payroll run and not having to spin your wheels all over the place. But kind of making sure you kind of get that authorization of how these plans are going to be merging together, and then when and how are we going to transfer these assets over? What does the timing of this look like? So a couple of things that we want to kind of consider is, how do we know that the assets that are coming over from one plan to either a new plan, doesn't matter, the fair value of that is being transferred accordingly? So kind of to help make this a little bit more sense is, say Anna, she's in plan A, now she's going into the new existing plan B. She had $100,000 in, let's call it a target date fund 2060, because Anna's gonna be working for the next 40, 50 years. So she decided to move over however money she has there. So how do we transfer that investment? Is there a similar investment class that's being transferred to there, or does Anna have to pick a new investment class? These are all things plan management needs to kind of consider from any legal liabilities and plan investment, and kind of moving Anna forward on there. And make sure, like say Anna had 100,000, 70,000 doesn't transfer in the next day. We want to make sure kind of all the assets line up at a participant level and everything's kind of moving accordingly on here. So I always recommend, when a plan merger is happening, as Anna talked about earlier, one of the a common thing that we're not seeing is the documentation of the approval of a plan merger in there. So as part of your minutes, I highly recommend having that documented in there. And then as you're kind of working through the merger, you want to make sure all the assets are complete and accurate at not only a participant level, but the plan level, just to make sure you can map all the investments and keep everything going on there. Then what else we've kind of seen a couple times regarding employee benefit payment. So like say someone's taking like a annual annuity payment month over month, is when does that disbursement become part of the new plan or part of the old plan? It, again, comes down to the legal date and the legal transfer of it. And then making sure when you make the cutoff date of the legal transfer that payroll's submitting it correctly to the correct plan and not an old legacy plan. So you gotta, again, that comes down to the proper authorization on here. Next slide, please.
And Kevin, just to jump in real quick, when it comes to those reoccurring benefit payments, that is primarily on a defined benefit side, because you have individuals taking those annuities and they have those accrued benefits.
Correct. So then as we're kind of, like I just want to touch briefly upon like the more legal aspect of it. It's always very important to discuss with the ERISA counsel when the legal transfer happens, because it also may not be the same day that Anna's, in my example, 100,000 went to the new plan. The legal date could be like 1/1 that Anna's now a part of this plan, but her assets didn't transfer over until maybe let's call it the next month. And then so there's kind of a lag. So it's kind of making sure you have the controls in place to kind of keep flowing everything through. Again, the best way to do this is making sure you have board resolutions, as we talked about, due diligence of the plan and fiduciary responsibility is a big aspect of it. Making sure your plan document and restatements and any other legal documents are kind of up to par and kind of agree with the intentions of it. And then kind of what, oh, sorry.
Sorry, I was just going to jump in real quick. So one of the pitfalls we see here with that legal transfer date is when it happens right around year end. So in Kevin's example, with a 1/1 date and then it's later that year, that's a little easier to figure out. But when you have, say, a legal transfer date of December 31st, and then the plan assets don't transfer until January, that's when it becomes more complex and nuanced, because you really want to make sure that you're locking down that legal date, because that's going to drive a lot of the reporting.
Correct. Yeah, you'll have like one old financial statement under the liquidation basis of accounting, kind of showing a transfer out and then transfer in, which I think we might briefly touch upon it later, depending on time, but how it impacts the 5,500 as well. So we can go to the next slide on here. So as kind of the plan merger, kind of things you want to consider is how are we going to move these assets? Are these assets similar to one another? Do they make sense? A lot of times plan management brings in investment companies with fiduciary responsibility to help kind of line and kind of create a best case scenario for the employees in the plan. If you're creating a new plan, sometimes legacy plans already have a well-established committee, investment advisors who come in to talk about each of the fund's performance, and they can make edits on it and help line up how these assets of a plan will merge into a new plan. Or some of the times we've seen liquidating plans when the assets are moving in, all their investments just go right to the new plan, and it's just a change in the trustee of it, but all their investments are the same. So really kind of aligning your goals of how you want the investment performance of your employees' funds to do will make an impact on it. Yeah, and then kind of I mentioned earlier, I think it's really important just to get your reconciliations down between at the fund level, all the assets moving over correctly as authorized, at a participant level, everything's moving over correctly, and then the plan level, holistically, everything kind of makes sense. Make sure that transfer is really working. I think that's kind of a really important takeaway, is making sure all your assets reconcile. That's where issues can kind of come up when they don't reconcile.
And just to jump in again, what we have seen is that sometimes there are market gains or losses between the date that the investments are liquidated from one service provider to when they're deposited into the receiving service provider. So if you do have a difference between the two numbers, that could be market fluctuations, but that is something that you should be able to reconcile speaking with your service providers.
Correct. So moving on, kind of the last thing is, I think it's always good to have like a point person on here. and you can go to the next slide. Who's going to be the person who has the skills and knowledge to help kind of implement a merger? A lot of times it's a finance or accounting department kind of making sure all the assets are moving, and they're the responsible person to make sure that this plan is moved. Sometimes if a company's big enough, their legal department is heavily involved in making sure all the assets and transferred coming over. And sometimes it's left up to human resources and payroll teams just to make sure everything's moved. It really depends on the size of your company, but highly recommend you have like one project leader when you're doing a planned merger, just to make sure someone has oversight on it and they have necessary skills to help reconcile the plan and have knowledge about ERISA and kind of the inner workings of a plan document in there. Some other things that we've seen kind of involved in here is make sure your service providers are on the same page and how they are reconciling their assets. I'd recommend doing that from day one with both service providers, reconciling them. As you're probably going through a planned merger, you're probably going to be discussing issues and any potential things that might kind of like come out of a planned merger with legal counsel. For some hard to value investments, I've seen valuation specialists come in to say, is this really worth this as it moves over or upon liquidation of it? And then kind of really, so a lot of times like we're seeing healthcare, there could be some spin-offs of some companies going to another company. So kind of really defining who the divisions are of what employees are on there are really important for a planned merger, because I have seen instances where there's a plan, half of the plan participants in this one division go to a new plan, half of them go to another plan in there as part of the consolidation, just kind of align up with more of the function of what they do at the company, but it can cause issues. So just making sure you have kind of good documentation around who's in what division and how they're going to be paid and how you're going to identify them and properly move them from plan to plan. And I think that brings us to polling question number 3.
Yep, we're on to our third polling question. How familiar are you with the current IRS correction programs?
And I do see we had a question in the chat. It's how does the DOL track the deposits from all of these employers? So the DOL doesn't specifically track the deposits that the employers are making, like that timeliness. Where the DOL will, kind of where the DOL is going to step in is typically if you have a late deposit and then it gets reported on your Form 5500, that's just kind of a red flag, and that may increase your audit risk, where the DOL then comes in to audit the plan, because DOL does data mining on the Form 5500s. So it's really where the DOL, if they were to audit the plan, and sometimes if it's just they're auditing the plan because it's been randomly selected, they could come in and then see possibly those late deposits. So that's really where the DOL would see that in regards to those deposits.
Okay, so it looks like we're going to go right into the right topic on that, because some people are somewhat familiar or have a vague idea. So I guess, going right into the next slide, we're going to talk a little bit about some of the tax issues, including those IRS and DOL correction programs. Next slide, please. These are just kind of what we're going to touch on, really, the EPCRS and VCP programs, so IRS and DOL correction programs, talk a little bit about 403B plans, give you a little bit of a 5500 update, as well as a word on COVID-19 and its impact on benefit plans that, and in some cases, still being felt today. Next slide, please. So ERISA, established in 1974, really to help protect the plan and the assets of the plan. And what this did was essentially set rules from a fiduciary perspective, the 404 rules, indicating to fiduciaries that they have an exclusive purpose, so duty of loyalty to the plan, a duty of prudence, a duty of diversification in terms of plan investments. And ERISA also covered the operations and governance on the plan with requirements like needing to be reflected in a written plan document, obtain appropriate bonding coverage, reflect an ERISA compliant claims procedure, and avoid any prohibited transactions within the plan. However, as we know, nothing is perfect and mistakes inevitably will happen or potentially will happen. And so what do you do in those cases? Next slide, please. And just to kind of give an example, these are some of the different types of fiduciary and operational violations that plans do commonly experience. Less so on the fiduciary side, where you have failure to act prudently in selecting plan investments, failure to ensure that only reasonable administrative expenses are paid by the plan, or engaging in self-dealing. We see those much less often, thankfully. But much more common are operational violations. So things like failure to implement a 401k plan automatic enrollment provisions when you have a new group of employees coming in, or making plan distributions that are not provided for in the plan or in the plan document. So when one of these does happen, and again, much more on the operational side is what we commonly see, there are a few options in terms of getting the plan back into compliance and making sure that its qualified status would not be at risk. Next slide, please. Essentially, there are 3 correction programs offered that cover all the different range of violations that happen within benefit plans. You have the Voluntary Fiduciary Compliance Program, VFCP. This is a DOL program. You have the Delinquent Filer Voluntary Compliance Program, the DFVC, another DOL program, which is used for Form 5500 delinquencies. And then you have the Employee Plans Compliance Resolution System, the EPCRS, which is an IRS program as well for these types of failures, and does have 3 subcategories that we'll take a little bit of a closer look at. Ultimately, early detection of these errors is key, because it will really, as we'll see, reduce the cost and fiduciary liability if we're able to spot these and correct them before either the IRS or the DOL. So let's take a little bit of a closer look at each of these programs. Next slide, please. Starting with the VFCP. Essentially, this is used for fiduciary violations, and the idea is to restore the plan and its participants to the position that it would have been in had the transaction not occurred. The VFCP actually covers 19 specific fiduciary transactions, including delinquent participant contributions, improper loans, improper plan expenses. There is a model application form, an online calculator available on the DOL website that you can use just to actually apply for this and to fill out and determine potentially what the fee may be. And this is also crossed over with IRS enforced excise taxes for certain transactions. So depending on the transaction, you may be able to correct on the DOL side, whereas you're also liable on the IRS side, but they may allow this to happen concurrently and correct for both departments. Ultimately, just note that with the VFCP, there is no self-correction without DOL filing, and you're always going to have to actually submit something to the Department of Labor to correct. Next slide, please. The other big DOL program is the DFVC, and this is used for late filing of Form 5500. As you can see here, and we'll talk about a little bit later as well, there can be very significant penalties assessed by both the IRS and the DOL for these forms. Maximum on the IRS side of $150,000, and no maximum on the DOL side, with the penalty being $2,400 per day. So it's really critical to catch filing omissions before either the IRS and DOL do. And as long as you have caught it before them, you're allowed to correct using the DFVC, which provides plan administrators with the opportunity to pay reduced civil penalties for their voluntary compliance with these 5500 requirements. Now, there are 2 basic requirements for the DFVC. It's limited to plan administrators with obligations under Title I of ERISA, so essentially qualified plans, and who have not been notified in writing by the department of a failure to file a timely Form 5500. So again, absolutely critical to discover these omissions before the DOL. Next slide, please. Now, the DFVC, and really the major benefit of it, are the DFVC fees. Now, this can be up to $10 per day, up to a filing cap of $2,000 for large plans with over 100 participants, and $750 for small plans, so plans with less than 100 participants. And note as well that there's a per plan cap of $4,000 for a large plan or $1,500 for a small plan, which, as you can see, is a significant benefit and greatly reduces the potential penalty associated with these late filings. Just note, however, that there's no per sponsor or per administrator cap. It is a per plan cap. So essentially, for any plan, these are the maximum amounts that you would have to pay no matter how many years were actually delinquent. Note as well that the DFVC does not actually or does not technically relieve penalties under the Internal Revenue Code. So technically the IRS could still assess separate penalties. However, the IRS will generally waive these late filing penalties for Form 5500 filers who satisfy the DFVC requirements. So again, the DFVC is absolutely a critical program to be able to use if you do have Form 5500s that are delinquent, and really beneficial because it allows you to pay one capped penalty for every year that's outstanding. But just note again, if you do have several plans, that cap will apply per plan and not per plan administrator. Next slide, please. Now, the third program we're going to talk about is on the IRS side, and there are essentially three subtypes of corrections that are available under the EPCRS. There's the self-correction program, the voluntary correction program, and the audit cap, each kind of in ascending levels of severity. Next slide, please. The EPCRS in general has overriding and main principles, which are really fully correcting the error, making sure the plan terms at the time of the failure are reinstituted and followed, restore any benefits to the plan participants, essentially make them whole, and that the correction needs to be reasonable and appropriate and applied consistently across years for all operational failures of the same type. So taking a little bit of a closer look at each of these sub-programs, next slide, please. We start with the self-correction program, SCP, and this is for the least significant errors. And this permits a plan sponsor to self-correct the error without paying any fees or sanctions or without submitting any documentation whatsoever. Again, there's no filing, there's no fees. This does apply only to operational failures, typically ones that are insignificant, but potentially, depending on the type of failure, also certain significant failures can be corrected through SCP. You want to make sure that whatever methodology you are using follows general EPCRS correction principles that we just talked about, and you need to maintain these records to be able to demonstrate that the correction was made and what it was. Now, key at the end of the day, it's key to change your administrative practices so these errors don't occur in the future. Because if they do, ultimately, and if it could be considered, at least on the DOL side, as significant if it is habitual. So really, when you do go through the SCP program, you want to, number one, document the change and what you did and how you corrected. But really, you also want to document how you've changed and updated your administrative procedures so that the error does not occur again in the future. Next slide, please. The next level of compliance program is the VCP, and this is used for more significant compliance failures or for failures that may have originally not been significant but were not corrected within a specified period of time. Now, the only way to receive approval of a correction is to participate in the VCP, pay a fee to the IRS. You actually also have to file and notify the IRS via a submission. It requires their approval, and ultimately, this applies to all different types of qualification failures. Next slide, please. And this just shows a few examples of the type of common issues that we do see that require VCP correction. Typically, plan loan failures by a qualified or 403B plan, such as when a 401k plan loan exceeds the limits on 72P, missed corrective distributions for elected deferrals exceeding the 402G limit, which was $20,500 in 2022, failure to comply with required minimum distribution rules, and a few other types of operational failures that are listed there. And those are more of the typical types of transactions that we see come under VCP for correction. Next slide, please. And finally, we have the most, what I'll call severe of the three programs, the audit closing agreement program, or audit CAP. Essentially, if it's the IRS rather than you, the plan sponsor, who identifies the compliance error, then the only permitted correction program is this more expensive audit CAP. It's, like I said, when plan failures are uncovered by the IRS, VCP can't be used. Now, interestingly, self-correction may still be available if there are insignificant operational failures or significant operational failures that could be substantially completed prior to the audit. So you still do have this window potentially, if it's something that could be corrected by SCP, to go ahead and do that. Again, only if that correction will be completed prior to the audit. Now, as part of the correction procedures, you really have to make sure that all the participants and the plan itself have been made whole. And ultimately, at the end of this, the plan sponsor and the IRS will have to agree on the correction method, and it's not signed off on both by the plan sponsor and IRS. Next slide, please. Now, as part of this, the IRS will assess audit cap sanction fees. These are determined based on the, sorry, the slide right before that. These are determined by the IRS really based on the relevant facts and circumstances, including, you can look up in EPCRS procedures. There are multiple factors that come into this, including what steps did the plan sponsor take to avoid this, to identify it, to correct it. And the sanction fee can generally not be less than what it would have cost if you were able to go under VCP, that user fee. And there's just a short example there. And I think really the main point of that is the fact that the IRS is actually assessing a premium on the fact that they had to discover this versus you discovering this. So they really would prefer that the plan sponsor discover this, correct it either through SCP or VCP, and they don't have to do it. But if they do come to you first and they are the ones discovering it, they typically will assess a premium on their discovery of the failure. Next slide, please. And this is just a handy reference chart that I wanted to put in there because it really does speak to different types of issues as well as the different types of correction programs that potentially could be used to correct them. Next slide, please. Now this, I won't go into this too much. Anna had kind of referenced this issue earlier. This is a common one that we see where the IR or the DOL requires that deposits be made by the earliest date on which such contributions can be reasonably segregated. So in this example, you can see you had 6, 10, 5, 33, and 8. The 33 is a clear untimely remittance and obviously an issue that needs to be corrected. Next slide, please. So the resolution for this is really calculate lost earnings and restore the participants, make them whole. Potentially you need to file a Form 5330. Now, as mentioned, there is a box on the Form 5500 Schedule H where you're going to need to report this, which essentially may be a red flag for the Department of Labor. So bear that in mind. Your plan financial statements will have to report this as well, and potentially an ERISA required supplemental schedule detailing the transaction. Ultimately, you want to make sure you do follow best practices so that you can avoid this going forward. Just make sure everyone knows the rules about these timely contributions. As Anna mentioned earlier, make sure you have a policy around this and make sure you review this policy and the actual transaction so that they are in compliance with this. Next slide, please. Now, the IRS most recently issued RevProc 2130, and this actually brought a bunch of great changes to the EPCRS. Elimination of an anonymous submission process, but what they did add is that you can actually have an anonymous pre-submission conference under the VCP. So anonymously, you can discuss with the IRS the failure, the issue, and the potential correction under VCP before going through the program. They actually extended the SCP correction period for significant failures. Previously, you only had until the last day of the second plan year, and now following the failure, now you have until the last day of the third plan year. As we mentioned earlier, there are some instances where you have to go with VCP if you haven't corrected within the specified time. So adding that extra year should allow a lot more transactions to be corrected using SCP, which, as we discussed, is much easier. It also expanded the corrections that you can use SCP for, as well as flexibility in the recoupment of overpayments, where the de minimis amount in which you had to actually correct an overpayment went up to $250 from $100, taking the burden off the plan sponsor. And with that, I think we have polling question 3. Sorry, we did that. We did 3 already, right? Okay, guess we're right into 403B. So we also did want to talk about 403B, which is a tax advantage plan for employees of nonprofit organizations, such as hospitals, churches, public schools. Now, essentially, next slide, please. Similar to a 401k plan, employees can defer their salary pre-tax for tax-efficient growth and ultimately get that at retirement when you have less capital, when you have less of a, when you're in a lower tax bracket, sorry. And pay less tax on that money. Now, there's really 2 types of 403Bs you can have. There's the regular 401, traditional 403B, similar to a 401k, where contributions are deducted from your pay before taxes, lowers your overall tax bill today. And when you take out the money from account in retirement, you will owe tax on the withdrawal. There's also a Roth 403B option, in which you actually will pay the taxes now, but won't pay taxes when you withdraw your money in retirement. Next slide, please. Now, there's really 2 types of 403B plans. Some are covered by ERISA and some are not covered by ERISA. There's advantages and disadvantages to both, as we can see. But in terms of whether the plan is actually covered by ERISA, one of the key factors that are going to be looked at is whether the plan sponsor has a limited amount of involvement in the choices, essentially meaning that there is enough choice. The plan participants can really have a lot of autonomy in how they invest and in the different investment options. And that'll be one of the key things that are looked at in terms of 403B plan, whether ERISA applies. Next slide, please. Now, we just want to talk a little bit about 403B versus 401k, because there are very much a lot of similarities between these 2 types of plans. Obviously, only nonprofits and certain governmental entities can have these. In terms of eligibility, 401k retirement plans are issued by for-profit and not-for-profit employers, self-employed, whereas 403B plans, like I said, are only tax-exempt nonprofit, religious, or university employees. In 401ks, typically you'll see more investment opportunities than 403Bs. 401k accounts can include mutual funds, annuities, stocks, bonds. 403B accounts typically will only offer annuities and mutual funds. In terms of employer expenses, 401ks are generally more expensive than 403B accounts. A lot of times we see with 401k accounts, there are more sales charges, management fees, record keeping, other expenses. 403B plans, we typically see less administrative costs just because they know, these companies do know that these are not-profit organizations that are establishing these. So typically they'll take it a little bit easier on these. Now, one of the great advantages of the 403B plan is that it actually enables bonus catch-up contributions of $3,000 per year for employees who have worked with the same organization for at least 15 years. So potentially up to $15,000 extra that you can put away toward retirement versus a 401k. And universal eligibility, where essentially employers have to consider all employees eligible to participate in the plan. Versus a 401k, where that is not necessarily the case. 403B plans as well, they have to be able to do it as soon as they're hired versus a 401k plan where there may be a waiting period. Next slide, please. Now, the IRS has recently opened or announced that it will be opening its filings for the second cycle of pre-approved 403B plans starting on May 2nd, 2022, with a 1-year window to close on May 1st, 2023. So for anyone hoping to get a pre-approved document from the IRS, the window is now open and those should be submitted. Next slide, I'll just briefly skip over. You can see that as we discussed earlier, the penalties from the DOL and IRS have been increasing annually and ultimately potentially contain no maximum. So again, really important to use those correction programs where possible. Next slide, please. Now, there were final revisions for the 2022 plan year for the Form 5500. These have not been issued in final form yet. However, the update to the 5500 and 5500 instructions do indicate that there will be some changes, mostly as they relate to DB plans that have Schedule MB, SB, Schedule R. However, there are some other little changes on the Form 5500. Again, these are not final yet in the current year, so that's something we'll want to stay tuned and monitor throughout the year. Next slide, please. And finally, we did just want to mention COVID-19's impact on employee benefit plans. This has really caused employers to need to reevaluate their programs and policies. We did have several different legislation, the Secure Act, the CARES Act, the Consolidated Appropriations Act, and these did put a lot of provisions in place that affect benefit plans, including COBRA provisions, as well as external reviewer claim provisions. These are still essentially in effect because they are in effect through 60 days after the end of the national emergency, which has still not been declared. So these provisions are still in place, and it's something that plan sponsors should monitor to make sure they're complying with. And finally, for defined benefit plans, it's important to note that the Society of Actuaries' latest mortality tables were based on 2019 and really don't reflect the COVID-19 pandemic. So that's something you may want to discuss with either your actuary or audit team, depending on your specific plan provisions. But in general, the mortality tables aren't going to reflect the COVID-19 pandemic and its effects. So you want to make sure that you're updating your assumptions with that. And with that, I think we do have our final polling question.
Yep, here is our fourth and final polling question. Which organization can establish a 403B plan for their employees?
And kind of why this is going on, because I know we're out of time. There was a question on, is there a recommended solution for insurance contracts by nature are not able to be liquidated in the case of a plan merger to minimize the number of custodial accounts that make up a plan? Really depends on the contract. Those insurance contracts can be tough depending on who the owner of the contract is. Legal counsel should be able to provide you with kind of a best case scenario on it and what you can do to help minimize the effect of some of these contracts.
Yeah, but we have seen with a lot of, especially like the 403B plans, that there are legacy insurance contracts that even when the plans have merged, those legacy contracts are still held at the service providers. So if you do have that situation, it just opens up you know, a little bit of risk, because you want to make sure that you have a clear picture of all plan assets and that you're not improperly excluding those insurance contracts. Cool. So that's where the mapping of investments comes into play.
Cool. And then with this polling question, it looks like A+. We're almost AA+ on that question, so that looks pretty good.
Yeah, looks like everyone got it.
And then, of course, if anyone has any questions, you can always feel free to reach out to Anna, myself, and Izzy. Best practices, things you want to consider. Thank you for listening in. Hopefully, everyone learned something today. And then, yeah, I hope everyone has a great day.
Thank you, everyone. And as a reminder, the slides and recording will be distributed out to you later this week. Thank you.